Now, 2 quick secrets to retiring early. Number 1, you will get bored. Number 2, you might run out of money. Questions?
Do you have office hours tomorrow as well?
No.
Oh, okay.
You need to see me, come see me today.
Okay.
And of course, you're always welcome to email me, copy and paste whatever problem you're having into an email, send it to me, and I will work it out and get back to you. And I'm pretty darn quick, especially right before exams, because I know y'all are freaking out, right? Okay, questions? Okay, let's start on question 1. This is from Exam Practice Question Review, whatever it's called. In 2023, Funky Pants had cash flows from investing activities of $225,000. By the way, what does a parenthesis mean in accounting? Negative. Cash flow from financing activities of $175,000. Negative. The balance in the firm's cash account was $80,000 at the beginning of 2013 and $110,000 at the end of the year. What was Funky Pants' cash flow from operations for 2023? Now, when I look at this question, what I'm looking for is, what are they asking for and what have they given me? And when they do that, I realize we are looking at an accounting statement of cash flows. And they haven't directly given me that very last line of the accounting statement of cash flows, but they've given me the way to figure it out. Right, that last line on the accounting statement of cash flows is the change in cash over the course of the year. How much did cash change over the course of the year? $30,000. Okay, so what we can do here is we can set up our statement. So cash flows from financing, cash flows from investing, and it's all going to come down to change in cash, which we have already said is $30,000. Okay, now they're asking for cash flow from operations, so that's our X. Cash flows from investing activities minus $225,000, and cash flows from financing is minus $175,000. And so all I have to do to calculate this is to say, by the way, what's this plus this? I think it's minus 400,000. What minus 400,000 is 30,000? 430,000. So there's your answer. Questions? Okay, 1 down. Woo! By the way, anyone want to see number 2? Okay. You are evaluating the balance sheet for corpus correction. From the balance sheet, you find the following balances: cash and marketable securities, $300,000; accounts receivable, $100,000; inventory, $200,000; accrued wages and taxes, $50,000; accounts payable, $400,000; and notes payable, $500,000. What is Corpus's net working capital? By the way, here is the best way to approach these questions, and I haven't been doing it, and that is always start by seeing what they're asking for. Always start by seeing what they're asking for. If they're asking for net working capital, most likely you're going to be looking for current assets and current liabilities. And so what we need to do is go through here and categorize these things as current assets and current liabilities. And by the way, would it be beyond me to throw something in there that was neither one? Yeah, of course, I'm just evil, right? Okay, so let's go through and see what we've got here. Cash and marketable securities, what is that? Current assets. $300,000. Accounts receivable, what's that?
Current assets.
It's current assets, so we got 100,000 there. And then the inventory, what's that?
Current assets.
Current assets. Accrued wages and taxes. Current liability. Remember, anything with the word accrued in it and anything ending in payable, most likely is a current liability. So how much was that one? 50,000?
Yeah.
And then we have accounts payable. Current liability. By the way, do you think I might mix these up just to mess with you? Because, this is obvious, right? Current assets, then current liabilities, et cetera, who knows? In other words, you need to read. Notes payable, what's that? Current liability. Is that everything? Okay, so when I add all this together, I'm getting, what, 600,000?
Yes.
And when I add all that together, I'm getting 950,000? Does that sound right? No?
Yes.
Yes, okay, thank you. So what's net working capital? Okay, what is it? Negative 350. Is this company healthy? No, this company is headed for a bruising, right? Okay. Next question is number 4. Okay, let's practice looking at the question. It says, what was the end of the year balance for accounts receivable? Oh, hell. When you hear that, you know this is going to be really torture. By the way, if you see this question on the exam, save it and come back for it later. By the way, all the questions are worth identically the same number of points, right? And I've got half of them that all of you should be able to do, right? And then for some a lower percentage can do the next group and so forth. I've got to break down into the distribution. So what does that mean? If you are unlucky enough to get a difficult problem up first and you try to work these things in order, you could time out, right? And you don't want to do that. So go through, answer the easy ones first, then come back and start working through the more difficult ones. Okay, so Barney's Franks has net cash flows from operating activities for the last year of $21 million. Cash flows from operating activities. That tells us that we're looking at the accounting statement of cash flows. Now, the question is, which part are we looking at? They're telling us about the operating activities, but they're not saying anything about the financing or the investing. So I think everything is going to be located up there in that cash flow from operating activities area. Last year was $21 million. The income statement shows that the net income is $25 million. Depreciation expense is $7 million. During the year, the change in inventory on the balance sheet was an increase of $6 million. Change in accrued wages and taxes was an increase of $2 million. Change in accounts payable was an increase of $2 million. At the beginning of the year, accounts receivable balance was $7 million. What was the end of the year balance for accounts receivable? Oh my goodness. Do you see why this one's something you should skip, right? Okay, now, how do we arrive at the accounting statement of cash flows? It's called the indirect method. We start with net income. How much was net income? 25 million. And then, what do we add back? Depreciation. Okay, they don't mention anything about deferred taxes here. Now we need to start looking at our current assets and current liability changes. Yes, ma'am? Was it 7 million? Ah, sorry. Thank you. By the way, one of the versions on the exam will have 6. Okay, during the year, the change in inventory on the balance sheet was an increase of $6 million. Now, inventory, is it an asset or a liability? Asset. When assets go up, cash goes down. And so we see that the inventory was an increase of $6 million. What does that do to our cash? Decreased by 6, so minus 6. Change in accrued wages and taxes. Is that an asset or a liability? Liability. And it goes up by $2 million. When a liability goes up, what happens to cash? It goes up. So we're talking about plus 2? Okay. Now, at the beginning of the year, the balance of accounts receivable was $7 million. And so we've looked at basically all of our current accounts, except for we haven't looked at the change in accounts receivable. Yes?
You forgot an increase in accounts payable.
Increase in which one? Change in, oh, thank you. Okay, got one more then. So the accounts payable went up by 2 million. Accounts payable, is that a liability or an asset? Liability. Liabilities go up, what happens? Cash goes up, right? So we're looking at +2. Thank you. Okay, now, the only thing we've got left, if I haven't messed something else up, is the change in accounts receivable. Now, accounts receivable is a asset. When accounts receivable goes up, cash goes down. So we're looking at the minus the change in accounts receivable. And so, actually we'll do, minus change in accounts receivable. And so we're going to say here minus X, and that X is going to be our change in accounts receivable. Okay, now, what does all this add up to?
Cash flow from operating.
Yeah, the cash flows from operating activities, which they told us is 21. Now, here's what I would do if I were you. 25 plus 7 is 32, minus 6 is 26, plus 2 is 28, plus 2 is 30. Does that sound right?
Yes.
30 minus X equals 21. What must X equal? 9. Is that the right answer? No? It's not. Oh, yeah. So this is the most common mistake, right? What have we got to do now with this number? Yeah, you got to add to the beginning, because what we're looking for is the new accounts receivable. And so what I've got to do is take the old accounts receivable and add 9. Does that make sense? So at the beginning, the accounts receivable was 7. We're going to add 9. How much does that give us? 16. Is 16 the correct answer?
Yes.
Yeah. Most common, and I just slipped into it right there. Most common incorrect answer is 9. Questions? Okay. Friendly Motors began the year 2023 with $225 million in retained earnings. The firm earned net income of $40 million. They paid $15 million. By the way, they earned net income, so we know that's $40 million. They paid $15 million to their preferred stockholders, and their $10 million to their common shareholders. What would those payments to those shareholders be called? Dividends, right? What is the year-end balance for 2023 in retained earnings? So it's 2 steps here. First of all, we need to figure out what is the addition to retained earnings for this year that we're looking at, and then we need to add it to the accumulated retained earnings to come up with our new figure for accumulated retained earnings. Okay, are you ready? What is the relationship between net income, dividends, and addition to retained earnings? Yeah, net income minus dividends is going to be your addition to retained earnings. So what we're looking at here is 40 minus 15 minus 10. So I believe we're down to, what, 15 million? Okay, so now what do I need to do with that 15 million? What do I need to add it to? Yeah, the beginning balance for retained earnings, which was 225. So that puts us up to how much? What's 225 plus 15? 240. So our new balance is 240 million. Is that the correct answer? Very good.
Sorry, can you just run for that again real quick?
Okay, so we've got our beginning balance in retained earnings. And we're going to add the addition to retained earnings, and that's going to give us the ending balance.
Okay.
Now, this middle part, this addition to retained earnings, is going to be the net income minus any dividends they pay.
Okay.
So that net income is 40.
Yep.
And they're paying out dividends of a total of 25 to their 2 different kinds of shareholders.
They add both the preferred and the...
Yeah, they're both dividends. And so you can't retain it if you paid it out as a dividend. And I don't care if you pay it to the common shareholders, to the preferred shareholders, to your cat, your dog, doesn't matter. If you pay it out as a dividend, it's not retained.
Okay.
Does that help you out?
Yeah.
Okay, other questions? You are given the following information for Nichols Corporation. The net sales of $3.6 million. The cost of goods sold is $2.3 million. The addition to retained earnings is $0.1 million. Dividends, $0.2 million. Interest is $0.1 million. The firm's tax rate is 40%. What's the depreciation expense for Nichols Corporation? Now, this is another one that you want to skip. This is another one you want to skip. And here's why. We're going to have to attack this thing from two different directions, and it's going to be kind of funky. So, first of all, everything that we see here screams to me income statement. Does that sound right to you? Okay, what's the top line of my income statement?
Sales.
Sales, 3.6 million bucks. I'll go ahead and write sales over here. Now, what's the next thing? Cost of goods sold. And it's 2.3 million. And then we have addition to retained earnings. Is that on the income statement? So yet. It's like down further, right? In fact, they give us addition to retained earnings and they give us dividends. We're like, what the hell does that have to do with anything? If I add those two things together, what do I get? Net income. So we're gonna put a pin in those right now and we'll come back to them. And then we've got the interest expense. Okay, now they're telling us the firm's tax rate is 40%. What is the depreciation expense for Nichols Corporation? So we've got one more thing here. We need to, by the way, this is subtraction, right? So I'm going to put negative signs on these. We've got depreciation that we need to subtract out before we calculate our taxes. Does that make sense? Okay, so I'm going to have minus X here, and X is going to be our depreciation. Now, when I do this subtraction, what do I get?
Earnings before interest and tax.
Well, not before interest and taxes,
Earnings
right?
before tax.
Yeah, it's earnings before taxes, so we'll call it pre-tax income, right? And then we're going to subtract out our taxes, and that's going to leave us with net income. Does that sound right?
Yes.
Okay, we already said we know how to get net income. What did we do? Yeah, add your dividends and additional retained earnings. When you do that, I believe it's 300,000. Is that correct?
Yes.
Okay, now, here's the tricky part, or the fun part. Net income is equal to the pre-tax income. Oh, for shame, he's late. But at least he's shaved, except for that mustache. It's the pre-tax income times 1 minus T. If you make $1 and you're taxed 40%, that's 1 minus 0.4, leaves you with 60% of the dollar. Does that make sense? Okay, now all I have to do is rearrange this formula. Is equal to net income divided by 1 minus T. Have I broken any mathematical laws? I don't think so. Okay, so in this case, the net income is $300,000, and T is 40%, so this is 0.6 on the bottom. What's that going to be then for my pre-tax income? 500,000. And so now we're up to here. By the way, do I even have to figure my taxes?
No.
Nope, not if I know the fancy trick, right? Okay, pre-tax income. So now we are just down to plain old algebra. Do you see that? We've got 3.6 million minus 2.3 million brings us down to 1.3 million. Minus 100,000. Let's see. What's 1.29 million? Is that right? 1.2. Oh, you're right. Okay, so we've got 3.6 minus 2.3 gives us 1.3, and then this brings us down to 1.2. Okay, so we got 1.2 million minus X is 0.5 million. So how much does X have to be? $700,000. Is that the correct answer? Very good. Thanks, I got off by a decimal there. By the way, the reason my generation can do math in our heads, we were not allowed to use a calculator until we got into physics and chemistry. Never for a math class. Never, never, never. And I still mess up. Okay, here we go. That's number 6. Let's do number 7. Bill's blood bank balance sheet lists. Oh, by the way, what's the book value of Bill's assets today? What's the market value? This is helpful to go down and read those 2 questions, because now what we're going to do as we go through is we're going to identify things as market value or book value. So as we go through, we can make a little chart, and that'll help us to figure this stuff out. Okay, as we read through here, we're going to decide if each one of these things is market value or book value. What's the first thing? Net fixed assets of $22 million. What's that? Is that book value or market value? Book value. So we're going to say assets. And how much was it? 22 million. The fixed assets could currently be sold for 26 million. What's that? Market value. So far, so good. Glow's current balance sheet shows current liabilities of 6 million and net working capital of 4 million. Are those book values or? Yeah, those are book values. So what do we got here? Current liabilities and net working capital? And the current liabilities are 6, and the working capital is 4. Now, they say if all the current accounts were liquidated today, liquidated meaning sold, the company would receive $6 million cash after paying $6 million in liabilities. Okay, so $6 million in liabilities. So this cash that they would receive after paying them off, what would that be? Yeah, it's the net working capital, right? Are you with me so far? Okay, now they're asking about the value of the assets. We don't have the value of these assets right here. We need to calculate that. How do I get current assets given current liabilities and net working capital?
Once you add up the 6 million, 4 million, maybe 10 million, add the 10 million to the assets, so that would be 32 million for the book value.
Well, I want to walk through the formula first.
Oh, my bad.
Yeah, that's okay. He's jumping ahead. It's because he's smarter than I am. But we will make this work. Here we go. Here's the formula I want you to think about. Net working capital equals current assets minus current liabilities. Does that make sense? Now, how do I get current assets by itself? I got to add current liabilities to both sides, right? And so I know that my current assets is equal to my net working capital plus my current liabilities. So all I've really got to do is add these things. And I would get 22 plus 6 is 28. This is 32. And 26 plus 6 is 32. This is 38. Is that the right answer?
Yep.
Very good. Questions? Okay. Fancy Pants year-end price on its common stock is $5. The firm has a profit margin of 11%. Total assets of $25 million. Total asset turnover of 0.4. No preferred stock, and there are 5.5 million shares of common stock outstanding. What's the PE ratio for Fancy Pants? Okay. Now, when you see this problem, this is another one that I would tell you to skip on your first pass, because it's going to require quite a bit of footwork. So here's the way that I want to think about this. I'm going to start with the definition, or the formula for PE ratio. What's PE?
Share price.
Yeah, the share price. Price divided by EPS. Now, they tell me the year-end price on the common stock is $5. So I already have the price, so I'm going to put a check mark there. I got that. Now, the next thing I want to do is say, okay, well, I need to figure out this EPS. And EPS is going to be net income divided by the number of shares. And by the way, it's the number of common shares, and they say there's no preferred here. Anyway, we're all good. Do we have the number of shares? Yes. Do we have the net income? No, so that's going to be our next target. Net income equal to, let's see what information they give us. They give us profit margin. By the way, net income is profit margin times sales. Does that sound familiar? Did they give us one of those? Yeah. Okay, now we need to find our sales. And I'm going to start, by the way, finally they give us enough to get sales. And it's a little tricky though. They tell us the total asset turnover ratio. What's the formula for total asset turnover ratio? Yeah, sales over total assets. And so if I want sales, I'm going to say sales is equal to total asset turnover times total assets. Do they give us both of those? Yeah. So now we finally have enough to start solving here. So total asset turnover, 0.4. Sales is how much? 25 million? What is 0.4 times 25 million? 10 million. Very good. Okay, so now I can take that sales and put it up here. So the sales is 10 million. I'm going to multiply by the profit margin. What's profit margin? 11%, 0.11. And so I think this is 1.1 million. Does that sound right?
Yes.
Okay, now I finally have the net income. I've got 1.1 million in net income. I've got how many shares? 5.5 million. And something beautiful happens. What happens to the millions? Cancel out, right? And so this is 1/5, or how much? 0.2? Yeah, 0.20. So that is my earnings per share. And up here they told us that the price was how much? $5? And now we know our earnings per share is 0.2. What's 5 divided by 0.2? 25. Your PE ratio is 25. Miss Sego, you doing okay?
Yes.
Excellent. She actually looked kind of confident and happy. I was pleased. The rest of you? Okay. Any other questions on this one? Did you see how we had to go all the way to the bottom and then come back all the way to the top? Do you see how much time that took? And I know what I'm doing, right? So that's what I'm telling you. This is another one of those for you to skip. Questions before I erase this? Okay. Anybody want to see number 8? Okay.
That was
That was number 8? Oh, damn it. That's wow, you guys all had that right. In theory. AJ's Massage has asked you to calculate the firm's ROA for the most current year. ROA. Now, they're telling us that we've got 50 million in sales. The total debt's 20 million. The debt ratio is 40%, and the ROE is 15%. Using this information, what is AJ's ROA? Well, we know ROE is equal to ROA times the equity multiplier. Does that sound familiar? Okay, so they're asking us for ROA, and they're giving us some information that may lead to this ROE. or the equity multiplier. So what we're gonna do is rearrange this. ROA is equal to ROE over the equity multiplier. By the way, the equity multiplier, total assets over total equity. When I throw that thing to the bottom, what happens? Yeah, it flops. So I've got ROE times total equity divided by total assets. Does that look right? But there may be an even simpler way about this. We'll figure it out. Now they tell us that they've got 50 million in sales. I'm not sure we're even going to need that. They've got total debt of 20 million and a debt ratio of 40%. Let's talk about that debt ratio. That's TD over TA is equal to how much? 60%, right? Oh, 40%. Sorry, I'm thinking ahead. It's 40%. Now, here's the fun thing. TD plus TE is equal to what? TA. I want you to divide each and every one of these by TA. And what do we get? We get that this goes to 1, right? And if we know that TD over TA is 0.4, what must TE over TA be equal to? 0.6. Do you see TE over TA here? I may be totally wrong, but I feel like I'm onto something here. Okay, let's see. All wrong. Equal. What's the ROE is 15%? And by the way, I'm shooting for a percentage. I'm in a percentage. I'm okay leaving that as a percentage. I'm going to multiply by 0.6, and that's going to give me 9%. Is 9% the answer? Yeah. Any questions? Now, if I had given you debt to equity ratio, what would you have done? You add 1 to get to what? Equity multiplier, right? So there's 2 ways that could have gone. Questions? Okay. You are thinking of investing, is question number 10 on our list? Yes. You are thinking of investing in CyberDog. You only have the following information. At the end of year 2023, their net income is $800,000, their total debt is $18 million, their debt ratio is 60%. What is CyberDog's ROE for 2023? So typically, 2 ways that we get to ROE. One is by taking net income over total equity. What's the other one? Yeah, profit margin times total asset turnover times equity multiplier. So as we read through this, we want to get some clues as to which way we should head. They tell us the net income. So far it's looking pretty good. They're wanting ROE, and it's net income over total equity. We've got net income. So now we just need to figure out total equity. They tell us the total debt is 18 million and the debt ratio is 60%. Do you think we could figure out total equity with that information? Yeah, and so if we've got TD over TA is equal to 0.6, and we know we can actually solve this. TA is equal to, by the way, we've got total debt, right? We can solve this. So TA is going to be equal to TD divided by 0.6. Hopefully your algebra skills are mad enough that you were able to make that jump, right? So we've got 18 million divided by 0.6. What's that going to give us? 30 million. So our total assets are 30 million. Now, how do I get from total assets to total equity. Total equity is equal to total assets minus total debt. Does that sound right? So we've got 30 minus 18 is equal to how much? 12. And so now we've got the total equity. Net income was how much? 800,000? Divide by what, 12 million? What happens with these zeros out on the end? Yeah, they go away. These go away. And so we're left with 8 over 120. What is 8 over 120? Come on. Is that the correct answer? Okay. Number 11, Bunko. Bunko Inc. reported a debt-to-equity ratio of 2.1 times at the end of 2033. If the firm's total assets at year-end are $200 million, how much of their assets is financed with equity? Okay, we're given the total assets. They're asking how much is financed with equity. If we knew the equity multiplier, that would be really easy, wouldn't it? Gee, what have they given us that would, what's that? Yeah, the debt to equity ratio. All I've got to do is add 1. So my equity multiplier is going to be 1 plus the debt to equity ratio, which in this case is what, 2.1? So now we're up to 3.1, and we know that is equal to total assets over total equity. And they're asking how much is financed with equity. And so all I've got to do is say TE is equal to TA divided by 3.1. Do they give us the total assets? Yeah, so we're just going to throw in that 200 divided by 3.1. I'm getting 64, I'm getting this one right here. Is that the right answer?
Yeah.
Cool. Now we're on to number 12. Last year, Marquis Corporation had an ROE of 12.75% and a dividend payout ratio of 30%. What is the sustainable growth rate? So hopefully you remember that the sustainable growth rate is equal to ROE times B divided by 1 minus ROE times B. Does that sound familiar? Do they give us ROE? Yeah. Boop, boop. What about B?
1 minus.
Yeah, we got to do 1 minus the dividend payout ratio. By the way, what's the most common mistake students make on this one? They use 0.3 instead of 0.7. Okay, so we know that B is equal to 1 minus 0.3 is equal to 0.7. And so we are, and by the way, you do need to convert to a decimal. When you start throwing stuff into this equation, you've got to convert to a decimal. So we're looking at 0.125 multiplied by 0.7 divided by 1 minus 0.125 times 0.7. Are we good so far? Okay, now I'm going to show you what I would do if I were you in the calculator. I'm going to say clear, and I would start at 0.125 times 0.7. That is ROE times B. And what I'm going to do is store that in location 1, stow 1. And the reason I'm going to do that is because it shows up in the problem twice. And so then I'm going to say divide by. open parentheses, 1 minus, what do I do next? Recall 1. Close parentheses, equal. I'm getting 9.59%. Was that the correct answer?
Yes, sir.
Okay. Last year, crumb cake had an ROA of 7% and a dividend payout ratio of 80%. What is the internal growth rate? IGR is equal to ROA times B divided by 1 minus ROA times B. Is that right? Okay. Now, they tell us the ROA was 7%, the dividend payout ratio is 80%. What is B? 0.2. It's just 1 minus 0.8, right? And so we're going to be looking at 0.0, is it 0.07?
Yes.
7%. 0.07 times 0.2 divide by 1 minus 0.07 times 0.2. So we're going to go to the calculator. I'm going to hit clear. And what am I going to do first? Oh, come on. 0.07, the purification ritual. I should hope you're not in that bad of a shape at this point. 0.014, does that sound right? Now, what am I going to do with that number? Store 1. Then I'm going to divide by, open parentheses, 1 minus, what do I do next? Recall 1. What do I do next? Close parentheses, equal. I'm getting 1.42%. Is that the correct answer?
Yes.
Question 14. They're asking about the firm's internal growth rate. Now, when we figure internal growth rate, do we need ROE or ROA? ROA. Okay, now, as we go through here, we need to look for information to find ROA. They tell us that the firm has a profit margin of 7.5%, total asset turnover of 1.5 times, debt to equity ratio of 0.9, a net income of $550,000, and net dividends paid to common shareholders of $100,000. Let's start out with the formula here. Let's see, looking for the internal growth rate. That's ROA times B divided by 1 minus ROA times B. How do I find B? Yeah, so I can either take 100,000 divide by 550,000 to find my dividend payout ratio, or I could just take 450,000 divided by 550,000. How did I come up with 450,000? Yeah, I just subtracted the 100,000 in dividends. And so the retaining 450,000, and so here we go, 450,000, 450, 1, 2, 3, divide by 550. Do I even have to put the 1, 2, 3? No, I don't. Equals. So I've got 81.81% repeating. Is that what you guys get?
Yep.
Okay, now I'm going to go ahead and store that because that's a funky number. I won't be able to remember that. So I'm going to say store 0 because we'll store the ROA times B as 1. Okay, now the next thing is we need to find out our ROA. Now we know that the DuPont ratio says ROE is equal to profit margin times total asset turnover times the equity multiplier. Therefore, what is this bit right here? ROA. So all we really need to know is the profit margin and the total asset turnover. Did they give us those?
Yes.
Yeah. And if I take profit margin of 0.075 and multiply by the total asset turnover of 1.5, that's going to give me my ROA. Let's see, I'm going to take 0.075 times 1.5. And that gives me 0.1125. Is that what you guys get? That's my return on assets. Now, what am I going to multiply this number by to get this thing right here? That,
8181.
yeah, the one that we already stored. And where did we store it?
You put it in 0.
I put it in 0. Multiply by, recall 0, equal. So this is this piece right here, also this piece right here. What should I do with this number right now? Store 1. Now, what do I do? Divide by, what's next? Open parentheses, 1 minus, recall 1. Close parentheses, equals. I'm getting 10.14%. Is that the correct answer? Okay, you had to be a little tricky on that. By the way, did I give you more information than you actually needed to solve the problem? Does that piss students off? Yes. Now, let me explain to you why we do that. In the real world, you will likely not have enough information to solve the problem. If I did that to you on an exam, you guys would hunt me down with pitchforks and torches, right? So the best simulation I can do is to give you more information and let you be able to pick out the correct stuff that you need. Okay, that was number 14. Wheat Corp ended the year 2023 with an average, with an average collection period of 60 days. The firm's credit sales for 2013 were $12 million. What's the approximate year-end balance in accounts receivable for Wheat Corp? By the way, when we're talking about average collection period, we said there was another name for this. Day sales and receivables. So it's days in AR. And we said that the formula for this is, let's see, what is it?
365.
Okay, so we're looking for days in receivables. Oh, okay, so this is 365 divided by receivables turns, right? Okay, now what are receivables turns?
Sales over accounts receivable.
Sales divided by accounts receivable. So I could say this is also the same as 365 times, so if sales divided by accounts receivable, if I flop that, what happens? Then the AR is on the top and the sales is underneath. Does that make sense? Receivables turns is sales divided by AR, so when we flop it, this is how it ends up. Okay, so do I have an accounts receivable number? That's what I'm looking for, right? And so what I want to solve for is this right here. And so I'm going to say accounts receivable is equal to ACP times sales divided by 365. Does that look right? Accounts receivable is the collection period times sales divided by 365. How much, and by the way, in those that receivables turnover measure, it's always the credit sales. It's always the credit sales. If I tell you that 80% of the sales are on credit, you need to take 80% of the total sales. Unless I tell you otherwise, you are to assume that all sales are on credit. Unless I tell you otherwise, you are to assume that all sales are on credit. But here they tell us that it's credit sales of $12 million. And so all I've got to do is take 60 times my 12 million, divide by 365. So it should be something slightly less than $2 million. Is it 1.9726? Yeah.
Yes.
Does that make sense? Any questions? Are you starting to see why I told you algebra was important for this class? Number 16, if Climate Inc. has an ROE of 15%, an equity multiplier of 3, and a profit margin of 10%, what's the total asset turnover ratio? Oh my goodness, what equation are we going to use here? The DuPont identity. The DuPont identity says ROE is equal to profit margin times total asset turnover times the equity multiplier. And they are asking for total asset turnover. So total asset turnover is simply ROE divided by PN times EN. Do we have all those numbers? Yeah, so we've got 15% divided by profit margin is also in percentages. What percent is that? 10%? And the equity multiplier is how much? 3. And so the percentages cancel out. And I end up with 15 over 30, which I think is 0.5. Does that work? Yeah. That's one of those when I read that question, I'm like, whew, am I going to use net income over total equity? No, I'm going to use the DuPont identity. Any takers on 17? We didn't get a circle earlier. Okay. Ooh, you will receive a $750 cash flow in 2 years, $1,000 cash flow in 3 years, and pay $300 in 5 years. If interest rates are 6% per year, what's the combined present value of these cash flows? Take a little time and draw your table. So the last cash flow we talk about is 5 years. So I'm going to say T, I'm going to have 0, 1, 2, 3, 4, 5. What happens at time 0? Nothing. What happens at time 1? Nothing. What happens at time 2?
Receive 750.
Receive 750. I'm going to call receiving money positive. I always like to receive money. Okay, now what happens in year 3?
Receive 1,000.
Yeah, you receive 1,000. What happens in year 4? Nothing. What happens in year 5?
Pay 300.
Pay 300. What's the sign on paying?
Negative.
Negative. Okay, now get your calculator out. Can anyone tell me what we're going to do here? CF. What's the first thing I do after I hit CF? Second. Clear work. Remember, the calculator will always remember what you've previously done, so you got to get that out of there. Okay, C of 0 is 0. We're good to go. Arrow down. What is C0, 1?
0.
0. And I got to hit enter so it knows that I actually mean 0, right? And then I'm going to arrow down. What is F0, 1? 1, right? It's the frequency. How many times does that cash flow happen in a row? It only happens once. I'm going to hit enter, arrow down. What's C02?
750.
750. Enter. What's F02?
1.
Just 1. Arrow down. C03. What's it?
1,000.
1,000. Enter. What's that 03? 1. I just got to arrow down. It's okay not to hit enter on that one. C04, how much is it? 0. I've got to hit enter. And then F04 is how much? 1. And then this last one, C05, 300, negative, enter. By the way, if you don't hit enter, it's like it never even happened, right? You got to hit enter. Okay, now here's one thing I like to do when I get done. I like to flip back up through here and make sure that I've got my cash flows in there, because sometimes I forget to hit enter. Now, if I were to find the present value, the sum of the present value of those cash flows, what button should I hit next? NPV. And it's going to say I. What should I put in for I? 6. Enter. Arrow down. What button do I hit next? Compute. And when I do, I see it's $1,282.94. Is that the correct answer?
What do I do if the calculator doesn't go to the CO5?
It means either you bought a Chinese knockoff or let me take a look at your calculator. Probably the reason it won't go down to CO5 is because you didn't hit enter on C04. Try hitting enter. There we go. Okay, remember, if you're doing 0, you've got to go ahead and hit enter for it to recognize that it's a cash flow of 0. There we go. Questions? By the way, you can tell the Chinese knockoff TIBA 2 pluses because they have red buttons. They have red buttons instead of gray buttons. It's weird. Okay, don't buy those. Question 19. A small business owner visits his bank to ask for a loan. The owner states he can repay a loan at $2,500 a month for the next 3 years and $1,500 a month for the next 2 years after that. If the bank is charging 9% APR, how much would they be willing to loan the business manager? What did we say last time? When you borrow the money, the amount you borrow is the present value. It's always the present value. So what we're really asking here is, what are the present value of these cash flows? Now, the easiest way to do this, and so we're going to do CF second, clear work. CF0. By the way, when you borrow money, do you immediately have to pay the first payment? No, it's the end of the month, right? Okay, so CF0 here is 0. What is C01? 2,500. Enter, arrow down. What's F01? 36. Why is it 36 instead of 3? It's monthly, right? 36. Enter, arrow down. What's C02? 1,500. Enter, arrow down. What's F02? 24. Enter. Okay, now what button should I hit next? NPV. And what should I put in for I? 9 divided by 12, because we have an APR and we need the monthly. 9 divided by 12 is 0.75. I've got to hit enter. What should I do next? Arrow down and then compute. They're willing to loan us $103,706.87. Does that look right? Yeah. This is so much easier. A lot of times people they're like, well, I'm going to figure out the present value of this set, and I'm going to figure out the present value of this set, and I'm going to discount this set back to here, and then I'm going to add them together. Don't do that. Let the calculator do the work for you. That's what it's here for. Questions? Payday loans are very short-term loans that can charge very high interest rates. You could borrow $500 today and repay $600 in 2 weeks. What is the compound or effective annual rate implied by this 20% rate charged for only 2 weeks? By the way, did they have to tell you it was 20%? 600 minus 500 divided by 500 gives us 1.2. It gives us 0.2. So it tells us it's our 20% rate. But is that 20% per year? No, in fact, that's 20% per 2-week period. Now, we know in order to get to our APR, we have to do the number of sub-periods multiplied by the sub-period rate. Our sub-period rate here is 20%. Actually, let's go ahead and leave it as a percentage. You'll see why here in a second. 20%. How many subperiods are there in a year? So how many weeks are in a year? 52. By the way, most common answer I get from students on that one is 54. I'm like, are you high? Okay, so 52 weeks in a year. How many 2-week subperiods? 26. So this is going to be 520%. Now, you don't have to do that math in your head. Here's what I'm going to show you, the easy way to do this. We're going to say clear second ICONV. Second ICONV. It's above the number 2, second 2. Now, nominal, stated, quoted, and APR are all the same thing. What do you think I should put in here? Yeah, 520. Or if I'm lazy and I say 26 times 20 equal enter. You got to hit enter or it's like it never happened. Now I'm going to arrow up. What do you think C per Y means? Compoundings per year. How many times per year is this thing compounding? 26. 26. Enter. Arrow up. Right, this is going to be the effective, or EAR, and it's telling me right here I need to hit compute. So I'm going to hit compute, and that tells me it is 11,347.5%. Students will hardly ever believe that answer when it comes up because it's just so freaking huge. And this is the problem with compounding, right? This is the problem with this is why I like to earn compound interest, but I hate to pay it.
Question?
Yeah.
The 26 comes from the fact that it's every 2 weeks and every year has 52 weeks.
Yeah, so 52 weeks per year, 2 weeks per subperiod, and so you end up with 26 subperiods per year. Good question. Other questions?
How do I clear the previous nominal from the?
You just type over it.
Um,
Yeah. I mean, you could. So take a look at this. I could do second ICONV, and the old number's there. And I could hit second clear work, and that one clears out. But guess, take a look at this. Boop. That one stays. And the reason that one stays is because the calculator is made for car salesmen and mortgage brokers, right? And so they're going to leave, and for them it's always going to be 12, right? But you're more clever than they are, and so you may be doing different numbers. You have my apologies. More importantly, just type over the old numbers. Okay, questions? After saving your entire career, you and your spouse are ready to retire with a nest egg of how much? $800,000. You'll need to invest this in a mix of stocks and bonds that will allow you to earn $7,000 per month for 20 years. What is the annual interest rate you need to earn? Okay, now a lot of times people get confused here and they think this $800,000 is a future value. It's not. It's the beginning of retirement, right? And so your present value is going to be $800,000. And by the way, we're going to make that a negative because of the signing convention. And they're wanting to earn $7,000 per month. PMT is equal to 7,000, and it's positive because it's in the opposite direction. And they want to do this for 20 years. What's N? 240. Why is it 240 and not 20? Because we're looking at monthly payments of 7,000. Okay. Now, what APR do we need to earn? Is that all the information? That's all the information. Okay, so here we go. I'm going to be using the TVM key, so the first thing I'm going to do is second clear TVM. I'm going to put in my 800,000 negative present value. I'm going to put in 240 for N. I'm going to put in 7,000 for PMT, and then what am I going to compute? Yeah, compute I over Y. Now, is it 0.71%? No, we're looking for the APR. We got to multiply by 12. By the way, do you think I would also include something that looked like that first number as a choice?
Yes.
Yeah, because I'm evil like that. Okay, so 8.61%. Any questions? Most common mistake? Students don't multiply by 12 at the end. What annual percentage rate would you need to earn if you wanted a $400 per month contribution to grow to $32,668 in 5 years? By the way, this is a monthly contribution. We're going to get our calculator up here. Second, clear TVM. What should I put in for PMT? 400. And I'm going to make that negative because we're going to have to do the other one positive, right? And what would N be? 60, because we're looking at 5 years, 12 months a year. That's 60. Now I'm looking for APR, so I'm going to try to compute I per Y. But what's this 32,668? Yeah, it's actually a future value because I want it to grow to that. 32,668 future value, and then I'm going to compute I per Y. Is the answer 1%? No, the answer is 12% because we have to multiply by the number of months in a year. Does that make sense? Okay. Now, here is the final one that I would tell you I would recommend skipping and coming back to. The car company is offering a choice of deals. You can receive $1,000 cash back on the purchase or a 3% APR 5-year loan. The price of the car is $38,900, and you could obtain a 5-year loan from your credit union at 7% APR. What's the monthly payment of each deal? So what I'm going to do here is I'm going to have 2 columns. Cash back. And the other one will be the 3% APR. Those are your choices. You can't mix and match. Those are your choices. Now, for each one of these, we are buying this car for $38,900. If I get $1,000 cash back, how much am I actually borrowing? $37,900. I'm going to make that negative. How much am I borrowing at the 3% APR? $38,900. How many payments?
60.
Yeah, for both of them. They're both 5 years, right? And then I'm going to have my I per Y. For the 3% APR, it's going to be 3 divided by 12. Why am I dividing by 12? Yeah, it's the APR, right? 12 months. Over here, where are we going to get the money if we don't get it from the 3% APR? Well, they say they can borrow from the credit union at 7% APR. So what should this be? 7 divided by 12. And then, I believe, we'll be able to compute the payments. Okay, so here's what I'm going to do. I'm going to get my calculator up. Second, clear TVM.
I have questions.
You have a question?
Yeah, the IRR of the cashback should be 3%, right?
So for the 3% APR, it should be 3 divided by 12. Because 3% APR is per year, and you got to divide by 12 to get monthly. And why am I using monthly? Monthly payments, right? Does that make sense?
Yeah.
Okay. So here we go. Second, clear TVM. I'm going to put in 60 for N. And I'm going to put in 37,900 negative for present value. And 7 divided by 12. Got to hit equals here. I per Y. And then what do I compute? Payment. I'm getting $750.46. 46, 47? 47. Okay, now, I can go back and clear this out, but my end's going to be the same, so here's what I'm going to do. I'm just going to type over 38,900 negative, what button should I hit next? Present value, right? And my I per Y is the other thing that changed. 7 divided by 12 equal
It should be 3 divided by
Oh,
12.
sorry, you're right. 3, thank you. 3 divided by 12. I thought that number looked familiar. I over y, and then what do I compute? Payment.
Okay.
Looking at $698.98. Now, which one of those would you prefer? Yeah, you'd be amazed at how many students are like, I'll take the higher payment. And I'm like, why? When you're making money, you want the higher payment. When you're paying money, you want the lower payment. If you learn nothing else in your MBA program today, I hope that sticks with you. Okay, we have 4 minutes. Someone said, what if I have content questions? Boop, this is your chance, yes.
What's an easy way to compute principal and like future time in terms of refinance and amortization loan without making amortization too?
Oh, to figure out the total amount of interest paid, the first thing you do is figure out what's the payment. And then you multiply that payment amount times the number of payments. That gives you the total amount of money that you've paid. Now, that total amount of money paid represents both principal and interest. So if I want to get interest by itself, all I have to do is subtract the principal, which is the amount that you borrowed.
Yeah, but let's say 3 years into repaying the mortgage, you want to like refinance at a different rate.
Oh, well, then you're into amortization. I don't have a nice slick one like that for you. Excel. Other questions? By the way, your calculator can build amortization tables. It's a huge pain in the butt, and I still can't manage to make it work right. So good luck with that. Oh my goodness, folks, why does our calculator show BGN? It's set for the beginning of the period. So the next question is, how do we get her out of that? Anyone? Second payment. And then second interest. Folks, before the exam, you might do the calculator purification ritual just to make sure that your calculator hasn't gotten high in the meantime.
Which one was that? Do you want me
Because
to
it
read?
happens. Other questions? Other questions? Oh, yes.
Best way to study the conceptual questions through the practices, because there's a lot of alternative on there.
Okay.
Go through all.
He's asking about the best way to study for the conceptual stuff. So what's fair game for the conceptual stuff? What I've talked about in lecture, what's on the PowerPoints, and what's in the book. Now, are there things that I've hit pretty heavy in class that I don't hit, or that wasn't necessary, or let's say, are there things in the book that I haven't necessarily hit heavily in the class? Yes. So I would put those further down on my list of things to study. Am I going to try to find a footnote in the book and trip you up over it? No. If there's an important footnote, and there is one in chapter 11, if there's an important footnote, I will point it out to you in class and we will talk about it. Other questions? So your study guide, I hate that word, your study guide for conceptual stuff would be look at the PowerPoints, and you could watch my videos from the lectures. That's going to probably get you 80-90% of the way there. And by the way, why do I tell you to read the book? Because what will happen if I say, oh, it's just what I said in lecture? Then you'll say, well, you never talked about that. And I'm like, well, this is why I say, and it's got to be, if it's in the book, you're still responsible, and that way I don't have to put up with, oh, you never said that, and then I have to go back and find it in the video and show it to you. And you say, oh, I was asleep then. Questions? Say again?
It's like two-week payments. So if you're doing 2
Oh
weeks
yeah,
out
the
of all
chapter
weeks, you divide by
practice
2.
questions are your second best preparation for exam. Your first best preparation is the exam practice set. Your second best preparation are the chapter practices. Your third best preparation are the homework. My primary purpose in the homework is so that some of you will get out of here with at least some points. Questions? Okay, email me if you have questions. Copy and paste the whole question, the solution, the whole thing. See you next time.